Good morning, everybody. Welcome to Phoenix Trading Strategies free trading room. Today is December 29th, 2014. Hard to believe that we're almost over with 2014 and about to begin a new year. Looking forward to that very much. Before we get started, let's go over the disclaimer. And here it goes. Future stocks and spot currency trading have large potential risk. Here's a disclaimer. Future stocks and spot currency trading have large potential rewards but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in future stocks and forex markets. Don't trade with money you can't afford to lose. This website is neither a solicitation nor an offer to buy, sell futures, stocks, or forex. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. Past performance of indicators or methodology are not necessarily indicative of future results. Being that said and done, let us continue with the home page. Now, what we're going to go over, and I like to go over this every day, is that one of the reasons why we created this technology was, number one, to give you strategic knowledge and information that would allow you to trade successfully. Because the discovery that we've made is that the banks have counter-programmed against most common indicators, whether they be moving averages, candlesticks, MACD, stochastics, RSI, Bollinger Bands, you name it. They have in one form or another counter-programmed against it. The only thing that they've even counter-programmed against their own volume. And we're going to go over that because it's important to understand how they report their volume through the aggregator to the dealers, which is reported to you on the charts. Now, what we've done is that we've synthetically created the volume in FX. Now, in futures, we don't have to synthetically create anything because there's a centralized exchange. However, even the volume is somewhat manipulated as well. And we're going to go over that. So today is going to be a very interesting day because, discovering that information, discovering how to use it against them is unique. And let's go to the charts so we can take a look at some examples. This is the US yen. And I actually like the US yen, not only because it's trading within this range. This is a new day, of course, right here. As you can see out the open, they basically move to the upside. And normally they don't do that. However, we've created an indicator that actually taps into their volume and momentum. So anytime that they are aggressively needing to rebalance their buy or sell positions, we tap into that. And when they do that, we're able to plot this information here, telling us that they're going to drive the market up, just the way they did here. Now, these previous levels, these previous lines, this red one and this blue one, as you can see, are where they previously plotted before. So these are price points that their algorithms and their programs are tapping into, which is very important because most of the time people don't really understand and cannot grip in actuality what the banks are doing. The banks have become very sophisticated. After 2008, when we had the subprime debacle, it actually took them about a year and a half to devise a new protocol. And that's when they started to implement this, which is very unique. And that's why we don't have these big, large moves per day of 300, 400 pips. If you've noticed, we have moves that are between 20, 40 pips, up to 80 to 125 pips. And if they're moving 80 to 125 pips, it's because they need to aggressively rebalance their positions in that specific currency. Now, what do I mean by rebalance? Everything's about managing risk. So they need to balance their risk in the portfolio of 8 major currencies, and that's what we're looking at here. We could look at others as well, other exotics like the U.S. Mexican dollar, the U.S. Singapore, the Kronos, etc. But we try and look at just the majors that are derived from the 8 majors, which are the Swissy, the Aussie, the New Zealand, the Euro, the British Pound, the Yen, and the U.S. dollar. And that's where we come up with this. Now, fair to say that because of this, we're able to determine how they are managing one specific currency against another. And for instance here, this indicator is basically telling you when it plots that they are, number one, no longer going to be trading below this level, and number two, that they're not going to be trading below this level. Now I want to use this as an example, and I want to go back in history because I think it's important. You see this level plotted in the 60-minute. So if I go to the 60-minute, and this level plotted in the 60-minute as well. These were more on the 15-minute, and they don't really matter because they start to really become a nuisance because they were on a smaller time frame. However, these levels, and I drew moving averages because I want you to see how it looks with moving averages as well. But let's take a look at this, from a simple perspective. Here on the 15-minute, and this was a few days back, you see how they plotted to this level and how they never broke, but they always came to it. Do you know why? Because they knew that as soon as they broke this level at 120, they'd have no choice, and this was 120.18, they'd have no choice but to drive the market up. Well, the same instance is with this one. They knew that if they broke this level, they'd have to drive it up, but if they stayed below it, they'd have to come down. That's why you can see here in this example, when they came up, they immediately came back down because they weren't ready to drive it up. And you can see here, as these plotted here, they came up, came down, never went below this level, because if they go below this level or this price point of 119.36, one thing's going to happen. This is very important. I need you guys to really understand this because it is the foundation of our theory and the foundation and concept of our technology, that the algorithms that they're using are looking at specific price points that historically everyone has traded within. Now, at these specific price points like 119.36, they know that if their algorithm trades below it, then they have to come down to this next level, which would be 118.89. That's a pretty good drop from 119.35 or 36 to 118.89. That's a good 40-50 pip drop. So why is it that they don't do that? Well, bottom line is that there's usually 3 to 4 banks that are controlling the major interest in a specific pair at a specific time each day. Never the same banks, because everyone's rebalancing their risk accordingly. That's a strong statement to make. Well, I'm going to prove it to you. And I'm going to open up this next indicator, which I think will be very useful to explain this concept. And this was created by friends of mine, PitView. Nice little indicator, works in real time, and basically identifies individual strength and weakness from the banks. Now, I'm going to drag these to the side because at this point we only need to be concentrating on the yen and nothing more. So give it a second. Okay. So here it is. Basically, this little indicator right here is telling you this is the US yen, and this is pair view. Now, they designed this to basically isolate each individual liquidity provider or market maker's interest. Important little tool. Why? Because it tells you that liquidity provider number 12, number 34, number 35, number 9, number 10, number 11, number 5, number 22, number 23, number 29 have in some form or another some interest in rebalancing their risk in this specific pair. That means they have controlling interest. So at this particular moment on the live edge of the market, liquidity provider number 12, which they cannot reveal what bank it is because of non-disclosures, it's telling us this bank controls 36.6% interest. Now it's also telling us that he's highly interested in selling. This one controls almost 32%, number 34. And he's interested in buying. Number 9 controls 10%, and he's interested in buying. Number 35 controls 7.3, number 10, 4.6, 3.2, on and on. So there's really just 4 major players. Okay? That's really what we're looking at. Everyone else is coming in and out according to how they need to buy or sell yen. No big deal. It's good to know that there's 3 banks that are driving this right now. So based on their interest, we're deriving how much interest is there really to drive this market. Well, when they're controlling, when it's evenly divided, and you can see here that in the past 5 minutes, this guy's been more interested in selling it by 16%. Well, he's really not interested in selling it, is he? This guy's interested in buying. This guy's interested in buying. This guy's interested in buying more than selling. You have more buyers than sellers, so there really isn't anyone out there offsetting the bids. That could be a good or bad thing. But I wanted you to realize and understand this because PitView does one good thing, and it isolates individual strength and weakness from the banks. But it tells you how many banks are in play. Now, my indicator doesn't do that, and that's okay because my indicator does something different. My indicator isolates when they're going to drive momentum and volume into the market before they drive it, such is the case here. Now, being this the case that when it formed here, it was pretty much at a new day, and as it was forming, they were trading around this price level, never really breaking it, and as soon as they broke it, they drove it right back up immediately, because they knew that if they didn't, they'd have to drive this thing all the way down. When their intent, or whoever was interested in driving this specific currency pair, was really trying to rebalance the risk by driving this up. And so they drove it up to this level, it came back down, and then drove it right back up. But this price is very important, and that's what I wanted to get to. That even here, we knew that they were going to drive it up, and the minute that they passed this level, they were really going to scream to the upside. So that is one of the reasons why I wanted to show it to you. But more importantly, is as you can see, they came up, and then they came right back down, and then they really came down to this level again. This same level of 120.19. So 120.19 became a focal point for them because they knew that if they went below it, they'd have to scream to the downside to 119.93. And if they go below this level, they know for a fact they've got to come down to 119.65. So it becomes sort of like a mechanism for them, which is automated. Now you're able to define that because we've defined it for you. Our system is not complicated. Our system is meant to be simple. So we're here right now, and so what is happening here is that they did drive it down, as you can see, to 120.19. But they knew that if they broke this level, they'd have to go down short. So they said, nope, we're going to go back up. And they did just that. And this is what happened on Friday. They came up, came down during the European session at around 6:30 a.m. They drove this up. And that's 6:30 a.m. Eastern. They couldn't fulfill the level, so they came back down towards the end of the day and closed here. Now the fact that they closed here and that this level was a continuation of this previous level, pretty much identified that this was a counter trend trade and they were going to continue to drive it up one more time to this level, which they did. So out the gate, or at the open yesterday at 5 p.m. Eastern Time, you could have caught this trade. Now granted, this trade is not the most significant trade. However, it would have been the easiest 26 pips you ever made of your life. And those 26 pips would have made the difference for your trading day. So it's important for you to conceptually understand that even when you have small ranges, our technology is doing that and more by giving you the trade that no one else is willing to identify. But it's doing it in a calculated manner that it eliminates fear and uncertainty of what is going to happen. Now, granted, they weren't ready to drive this any further than 120.58, and they came right back down. And as soon as they came below this level, 120.51, which is identified here twice previously in this 15-minute, guess what? They came right back down to 120.19. And they did not break below it because they know that if they break below this, they have to come down aggressively. And they don't want to come down. Now there's a reason why they don't want to come down and why they went right back up to trade above 120.51. Now they're trading up here, of course, and more than likely it looks like it's going to go long. But I was analyzing this pair yesterday with a customer of mine that bought the software. And we were looking at the higher time frames, and that's what I wanted to show you today, the higher time frames. And the reason for it is because it's important for you to understand that the higher the time frame, the more valid the trade. We actually found in the 180-minute that they've been preparing for a whole week to drive this thing long. And you're going to see right now when and where. Now, we're going over this because it's important for you to realize that you can't do this with a regular simplified platform like MT4. You actually need a professional platform. Bottom line is NinjaTrader does just that. Now give it a minute for the chart to populate because, you know, it just takes one. So here, for instance, I'm going to open this up and drag this to the middle. You see right here, this level right here, these dots have been plotting all of last week and all of this week. So now, basically for 2 weeks, they've been telling us that this is going to go long. Now it has gone long and then come right back down, and now it's gone back up. So on the 180, that's pretty significant because this is telling you that they're not done and they're going to drive this up pretty further. Now why am I showing you this? Because when it plots on the 180, look at this. This plotted below this same level, 120.19. And price action just came down 1, 2, 3 weeks. And this move was pretty significant because the total move on this one was 361 pips on the Japanese, on the US yen. This move here, here's another one. This one went 1, 2, 3, 4, 5, 6 weeks. So the higher the time frame, the more devastating the move for them, the better for you. 382 pips. Now I put these moving averages. You know, the turquoise is the 50, the white one is the 100, this brown one here is the 200. Now if I would have been looking at these, in no way or fashion would they have helped me to determine that this was going to go higher. Let's be honest. And the reason for that is that the moving averages are derived from price action from the open, high, low, and close. That's it. No way do they look at volume. And we're going to go into volume very soon because I think it's important for you guys to understand why volume plays a significant role in this. Now, so we understand that the higher the time frame, the more valid the move. Here's another one. Did the same thing. Plotted, and they ended up moving 326 pips. So the 180-minute time frame is a very good time frame to be looking at. Let's go back to the beginning. Here, for instance, now let's go back to the 60-minute, and then we'll end up back to the 15-minute before we look at another chart. But I wanted to show it to you because I think it's important for you to realize and understand that sometimes the smaller time frames are there to help you, but at the same time, you can only see so much. And this technology allows you to see in advance basically swing trades that normally you would miss or not pay attention to. Now, if you know for a fact that the 180 is starting to plot that the US yen is going to go long, then you're not going to be trading against it in a short fashion. Now, I wanted to go back in history because I think it's important for you to see, whoa, I went too far here. So I started to plot these lines based on these levels. Here, here, here. This one was on 30-minute, 60-minute here, 60-minute, 30-minute. I didn't need to go any further back in time. And now let's go to the 30-minute. So a lot of people say, well, you know, they trade off the 1 hour. Not necessarily. And I think that we've proven that. But they may use those price points within that 1 hour time frame to determine the range that they're going to be trading within. Doesn't mean they're making the decision to trade off of the 1 hour. That is a misconception. And the reason I say that, and I say that very strongly, is because everything that we're doing is mathematically calculated. So it can be proven and disproven. And that's something that very few individuals out there can say. Now this is a 30-minute. Now as you can see here, or maybe this was a higher time frame that I went to, probably was. But as you can see here, same thing. Identified the levels, you know, previously, and drew lines. No big deal. Now let's go to the 15-minute. You know, if you guys have any questions, it's okay. I'm more than willing to answer them. But I'm hoping that you guys really, really get a grasp of this, because I think this is important. These same levels that are constantly repeating themselves, and these are price levels, are important only from the aspect that the bank's trading desk and the algorithms that they've designed are using them as points of reference. Now, many people say, well, those are pivot points. They are not pivot points. Let's get that very clear right here, right now. Why? Because they change. They do not stay the same. Pivot points pretty much stay the same. These price levels do not. So here on the 15-minute, we've clearly identified what they're doing. And let's open this up a little tad right here. So here, for instance, we drew this line. Why? Because they made it a point of reference twice. When they came down, they came up, came down. Then they plotted again, and then they really came down. Now, at the open, this was during the weekend, of course. As you can see, on a Friday they closed, but they gapped down. So, and the total move on this was 25 pips. So am I saying that this program can predict what's going to happen over a weekend? Mathematically, yes. Yes, we can. Let's go back here. Same point of reference, 120.19 or 120.18, and came right back up to 120.51. So if you knew that these were your two price points of reference that they were going to be using, would that not make your decision process much easier? Now, that's one. And if you knew that they were going to, at the open, drive this long and take it to this level, would you not feel more comfortable placing a trade going to this level, knowing that if it comes right back down, it will come right back down to 120.19 or 120.18? The point is yes. Now, I normally don't take these counter trend moves. I like to take these moves. Whenever I see the power dots plot, this tells me it's time to go long. Now, the fact that they came back to this price level here, even though I didn't have power dots here, but I had them here, and as you can see, I can draw a line right here, a point of reference, and it will show that their algorithm came exactly to it and bounced right back up from it, even though this was our main point of reference, the 60-minute that identified 120.18, 120.19. They bounced right off of it, came back down, never looked back, and then drove up, and now the yen is going long. So I think the 180-minute solidified our decision process that this was going to go long. Now, granted, they played this game of up and down, but at the end, they're going to follow through, and they're going to drive this thing long. Now, how many days are they going to drive it long? Can't really say. And I actually got out of this position because I bought this position here. So I made a few pips, about 20 pips to it, but I regret not leaving because now I see that they're going to continue to drive it up. So that's okay. Now, this line right here is insignificant. Why? Because if this line would have plotted here or here, then I would have respected it more. The fact that it plotted here only told me that they were going to come right back down and then go back up. It wasn't really a good point of resistance because this was the main point of resistance here. And this only showed that they were going to go right through it. So if I'm considering the higher time frame, then the higher time frame is much more important to me. Now again, this isn't a big trade. However, it's a trade that if you would have taken, you'd be up right now 38 pips. Now granted, you would have had to jump in on this trade at around, this is about 10:15 my time, which is around 1:15 a.m. Eastern time. I'm on the West Coast, Pacific. So makes a difference. But if you would have identified these points of reference, you wouldn't fear whenever they come to them. And even if you didn't have the power dots here, you would have known that they know, historically, they are not going to break this level down because if they do, they've got to scream to the downside. But if they trade above this level, they have to take it right back up, which is exactly what they've done. So this is a good example, and I wanted to go over that because it's important. Now, let's go over volume. This is where it becomes really interesting because I showed you pit view and how it isolates individual interest based on their volume, based on the tick data that they are reporting from each individual bank. Now, this doesn't give you actual numbers, just gives you percentages, but it's still good because it isolates how many players there are and their percentage of interest. Now, even though this maniac right here is interested in selling, these guys are interested in buying, and that's what makes more sense, because that means that they're going to help number 12 rebalance his risk by getting out of his shorts, because he knows that from this point on, from 120.19, they were never going to go down. They were going to shove it right down his throat and take it all the way back up. Now, I know I get a little bit passionate, and that's okay. Sometimes it's good to be passionate, but it's good to understand the why. In this case, we're learning the why mathematically, because everything here that you see is mathematically calculated. And that's the one thing that you cannot contest, is something being mathematically driven and calculated, because you're eliminating uncertainty. You're eliminating fear. The reason why 95% or 98% of the traders fail out there is fear, uncertainty, and a lack of plan. They don't know how to plan their trade because they don't know where to begin. Our technology gives you a plan of action, removes fear, removes uncertainty, and tells you exactly from point A to point B what you can expect. And it's simple. More importantly, it's simple. If you know how to connect the dots, and remember, we used to do this in grade school. I used to love, grade school. I remember I used to have a teacher called Mrs. McDonald. What a nice teacher. Then I had this wench called Mrs. Warren. I hated her with a passion. But it doesn't matter. That's a psychological issue we have to overcome. But in between, she taught me how to connect the dots. So that's why I did this, to simplify it for you, because trading has become complicated for everyone. Now, let's talk about these purple dots. These are micro pivots. Now, why are they micro pivots? Because they are reversal bars. So that means that, if there's a reversal within 3, this will show it to you. And that's exactly what happened. Nice move on the yen. Looks like they're really going to drive it. So every time that they form, this one formed right below this level, saying, no way, no how are we going to come back down. Same right here. Look at this. Now, historically, these idiots will repeat themselves in any point or fashion. Here, they formed a pivot because, above, right below it, but to hold the resistance level right here. They said, in no way, no how are we breaking through, because we know that if we break through this level, we have to drive it up. Well, they drove it up. And that's exactly what happened. But then they came right back down, and they said, nope, we are not moving, because if we move, it is dangerous. Then everyone else's algorithm will say sell, 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 sell. And they don't want that, because they know that everyone will jump on the bandwagon here and say, if we sell below this level, then at that point, and look, number 34 is still rebalancing his positions. Now he's more bullish, of course. Now he's buying. And he's buying what everyone else is selling. Now, he knew that if he sold below this level, all these other banks' algorithms would go ballistic and rip him a new one and go sell, 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 sell to the downside. So instead, what he does, and this is where retail traders actually lose it, because they think, number one, let me put this right back here, they think that because it gapped down, oh, they're going to go short. This is where they induce you and manipulate the data to kick you right between the teeth and take your money. This is where we say, no, you don't. Why? Because this is where we analyze their volume at this level and tell you that they're going to rebalance their risk because they have to get out of their sell positions, because they don't have a stinking choice, because they know that if they don't, the rest of these banks are going to rip them a new one. So here, for instance, and I like to look at this. You're going to look at here, the buy volume, sell volume, and the cumulative. So here, for instance, now we're getting tick data here, and we're using a retail feed, so don't expect to see high numbers. However, what you can expect to see is that the information that is being provided is valid, because it's based off of the tick data that they're reporting. So here, and each tick represents a 100,000 contract or lot value. So here, they bid 13 million to the upside, 16 million to the downside. So they had a difference of 3 million, which was negative. Now, so what I'm telling you is that there was negative volume within this bar. So if the open, high, low, and close on this one was right here at the top in this specific bar, the open was 120.17, the high was 120.21, the low was 120.17, and then the close was 120.20. That's all you get, and that's what most volume indicators analyze, is just the open, high, low, and close, and put a moving average and go back 13, 14 bars. And then that's how they determine whether it's bullish or bearish. I'm telling you, based on their volume, based on what they're reporting, that they are negative here. But not only are they negative, see, here's where interpretation becomes very key. Why is that? Because this bar has negative volume, but what it's telling you is that they need to get out of their short positions, and that's why they're driving price action up. Remember, a candle is only driving price action, is driven by price action, not volume. Let's go over that. So this particular bar, they opened at 120.17. So that means that their bid and their offer has to go up in a parallel form for them to get to this level. So that means they have to bid, offer, bid, offer, bid, offer, bid, offer, bid, offer, and go up. If they hold the bid here and they just offer, 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 this thing doesn't move. So this was offer, bid, offer, bid, offer, bid, offer, and it went up. Now, again, they offered 16 million on the short side, so this was negative. 13 million on the buy side, but they drove it up. That tells you that they didn't unload the last 3 million that they needed to unload. This next candle, they needed to knock out 98 million on this bar. On the short side, they had to get out of that position. And they only offset 89 million, leaving 7.6 or 7 million or 8, or close to 8 million. Now, why is that important? That 7.6 means that they need to continue to get out of that short position. This next one, 67 million on the sell side, 100 million on the buy side, but it's a negative candle, Ricardo. What are you preaching? I'm not preaching. What I'm telling you is that now here they had more buyers than they had sellers at this specific level. So this next candle right here, you can see that they offered 79 million and had 110 million on the buy side. So they had a positive of 31 million surplus buyers. And that's why this candle became positive. This next candle, 46 million to 45 million on the buy side. This next one, 53 million to 49 million. They're still selling. They're still rebalancing and getting out of these positions. This next one, 41 million on the sell side, 60 million on the buy side, 19 million. And then, boom, it pops. 69 million on the sell, 103 million on the buy. They have a surplus of purchase of buying orders, and they drive this thing up. This next one, 51 million on the sell, 38 million on the buy, but they never, ever go below this level. So every time that they aggressively sell, you're expecting them to just break this price point. They won't do it. And that's okay, because what they're showing us here with our volume indicator, which is proprietary, which is unique because no one else out there has it, is that they're showing you that they need to get out of their sell positions. This next candle right here, 68 million on the sell side, 13 million on the buy side. So you're telling me that with a 55 million negative, they didn't break through this price point? They should have thrown the kitchen sink and blown through 120.19 with that type of volume, and they didn't. This next candle, 81 million on the sell side, 76 million on the buy side, and you're telling me they still didn't break this price and rip someone a new one? Now, you know what this type of price action is telling us? That there's a lot of retail traders thinking, and breakout traders saying, oh, this is going to go right through that price, and they're going to just rip right through it, and they're going to go right through the floor. And you know what the banks are doing? They're laughing their heads off, thinking, these poor fools have no idea that we've counter-programmed against the breakout. And now we're going to teach them a lesson. Because not only do they know that retail traders are loading up on the sell side here, because everyone's excited, oh, it's going to go right through this level, and we're going to make a lot of money. And then suddenly, as you can see, they never had the intention of breaking this level, because they knew that if they did, their algorithms would literally flip the switch, and instead of going long, go aggressively down. So these price levels are very important because they help you map out what the banks are doing. But more importantly is that the volume tells you with precision what they're really doing. PitView does a great job of describing what each individual bank is doing and how they're managing their risk. We isolate their volume, they isolate their interest. I call it a perfect marriage in heaven. Because you cannot dispute the mathematical fact. That is the bottom line. It cannot be disputed. So let's move PitView to the side. Let's get back here. So if you know that they're rebalancing their risk and trying to get out of the yen positions because they know that everyone's going to trade against them and drive it up, and this is a bank feed. There is no retail feed here. This is straight bank. This is a retail feed to retail traders, but in no way does this reflect what the retail orders are. This only reflects what the bank orders are that are being reported. Being that said and done, let's go here. They ended up driving it up. So everyone that went short got ripped. They came down, as you can see, higher level. Now granted, I put these moving averages because I wanted to show you that they're useless. But for some of you, they may be worthwhile. Even though the moving average isn't telling you, oh, it's time to go long. No, but my indicator does. This indicator starts to plot and it tells you, hey, pay attention. They're going to drive momentum and volume into the market, and they're going to continue to drive it up. And they did it in such a good way that it plotted right above this level, basically confirming that they were really going to drive it up. They drove it up. You know, didn't drive it all the way, came right back down. Then identified again, hey, we're going to drive it up. They waited a whole day over the weekend, and they drove it back up. Now we're here. Now here, I'm going to show you something very interesting. Look at the volume right here and this bar. They put 129 million on the sell side versus 100 million on the buy side. That's 129 million on this specific bar. And you're telling me that they're not going to drive this thing below this price point? The answer is yes. Why? Because they needed to get out of their sell positions in order to buy, because they were rebalancing. They knew that if they broke this price below, they were going to get killed. Slaughtered is the word. So in no way were they going to put themselves in jeopardy when they were just needing to rebalance a certain amount of yen. So they got out of their sell positions, and guess what? Suddenly everyone decided to come in. Oh, and look, you went from 129 million on the sell side to 100 million on the buy side, a difference of 29 million on the sell side. And then suddenly this next candle is 90 million on the sell side and 98 million on the buy side. And it moves more than this candle. How ironic is that? So there is no indicator out there that describes this type of price action and volume and momentum action. But if you understand the story that they're telling you, then these levels become your road map. And now you can easily understand why they drive so much volume around these levels and never move the candle, per se. Because they need to get out of their sell positions right here at this level. So with this type of volume in this specific candle, this thing should have, number one, exploded to the upside and come back down. And it didn't. It hardly moved. But look at that yen trade. Still going long. That 180 minute. Gotta love that thing. And it plotted right below this level. And it plotted for a whole week practically, telling you, hey, we're going to go long from this level. So hopefully this has been able to, I've been able to explain to you how you identify these price levels that are highly respected by the bank's trading desk and algorithms, and how they manipulate their volume and price action around these price levels to, number one, induce and trick the retail trader. So yes, when we say, and we say it very clearly, make no mistake, this is a financial war and you have been given no advantage. One could even say you have been sabotaged with the wrong information. We are not misleading you. We are telling you with precision that banks prepare their battle plans in advance to ensure that when you enter this war, your strategy will fail. Banks make you believe you have a fighting chance and let you enter the battlefield with a stick of information, because that's what you're going in, with a stick, while they have landmines, tanks, missiles strategically placed to drive you in the direction they want you to go that lead you to your financial slaughter. Every contingency has been taken by them to stop you from making money on this battlefield created by them, where they make the rules up as you go along. Oh yes, they play you like a violin, and that's exactly what they do at these price levels. They play you like a violin, because as soon as this thing came down short, everyone's like, oh yeah, we're gonna go short now, this is gonna go right through that level. And then they shove every point of volume and price action down there, and you're like, yeah, it's gonna go. And then boom, they slowly take you they take you where they want to take you, where no man has gone before, to lose their money, to lose your money and put it in their pockets. So you can't blame the broker. You can't blame the broker-dealer, because they're not manipulating the data. This data is coming straight from the banks, straight from the market makers. Now, here's another secret. Did you know that there is a liquidity provider between you and the banks? Because the banks quote at $1 million a tick, $1 million in order, not at 100,000. Let me show you why. Again, PitView has done a great job of demonstrating this, and I'm going to show you in 1 second. This is another indicator created by PitView, by my friends. Great indicator. It shows you market depth. Now here's a size, says 1, M for million. How many times they've changed on the inside of the bid and the offer. This is the bid, this is the offer. So liquidity provider number 24 has changed his position once already. Number 35 twice, number 28 twice. C24 did it -4 now. All 1 million, 1 million. This guy came in 22 with 2 million. 1 million, 2 million, 1 million, 1 million. this one here on the offer is 500,000, and this one's by number 28. So number 9 is coming in at 500,000. So yes, once in a while they'll throw in 500,000. That's why when our volume indicator shows you that there is data, for instance, that does not add up completely. For instance, let's find one that shows here, this one. See, this one shows 133 million on the sell side, 125 million on the buy side, and 7.4 million difference. It's not a, rounded number. It's because of this, because they're throwing in orders that are smaller, fractional as well. The minimum order that they will throw is 500,000. So sometimes you'll find that discrepancy here, but it's not that it's mathematically wrong. It's because they're doing it fractionally. So with market depth, if you're seeing market depth, now let me ask you something. This is market depth on the US yen, and this is at the second on the live edge on the market, can you make a decision with this? Because they're bidding this and offering and bidding, correct? They're offering more and bidding less. Is that gonna make a decision for you to take this up higher? The answer is no. You can't make a decision off of this information, can you? Exactly. So, being that said and done, now that we've covered that, let's continue. There is a question. Let me see. From our friend Jay Meisler. How do you explain the most recent dots that did not signal a top signal? Oh, up here, for instance, or these that did not? Okay, good question. I'm glad you asked that. So once in a while, the algorithm will just start to plot these dots in the middle of the range. Now, if it doesn't do it right below this level, and it's a little distant from it, then it's not a valid signal. I would have preferred them to plot here below, but it didn't happen. So sometimes they'll plot at this level, and so you cannot say, oh, this is going to go short when their intent was always to go long. Now here's another thing. I'm glad you asked that question. On the higher time frame, the higher the time frame, the more valid the move to the upside. So that means that even if they plotted here, they were never going to overcome the decision process that had been made in the higher time frame, which was the 180 minute. So all they showed you here was basically that there was volume and momentum that was going to be driven into the market, and it was going to come right back. And that's what they did. So as soon as they started to plot, yes, they drove volume down, but then they drove it right back up. And it became a very active area. Now, here for instance, I'll show you, let me get the cross here. Here for instance, this is us right now. Would you have made a decision to go long from here? When they're trading so close to the high? Not really. But you could have made a decision if this was telling you that they were going to drive momentum and volume to the upside, because that's what this was signaling. So, glad we were able to look at this example. Great example. As you all know, the red dots are basically trend dots. These red little dots, and they're not dots, they're actually plus signs. And I'll expand this out further so you can see. My mistake. Let's go back. As you can see, they're plus signs. This is actually a trend stop. This is an ATR level. Now, most of you understand an average range of, so this is, based on, no, this is an ATR level per candle, not per day. Don't confuse or misunderstand. But I use it as a trend stop. So that means that if they come and challenge it, if they break below it, then of course the trend will change and it will become negative. Or in this case, it'll become bearish. In this case, it's bullish. But what I like about this specific trade is that even though they started here, as soon as the candle started to trade above the trend dots, they were never really going to come down and challenge this. And they were just going to continue to move to the upside, which they did. So this total move would have yielded you right now, if you would have been in it from the beginning to the end, 44 pips. Granted, you would have had to have gotten in at around 10:15 p.m. my time, which is 1:15 a.m. Eastern time. But knowing that this level was never going to be breached, this was a slam dunk for you. So, good example. Let's go to another example. Now let's open up the market analyzer. Now the market analyzer is a great tool, and we just created this thing. And what this tool does is that, you can take all your favorite pairs. In this case, I got 14 pairs up on this thing. Now, I got to change this because this here where it says Phoenix Power Dots should say trade with me. And here in the congestion, which are these dots, congestion dots, it should say analyze me. It doesn't matter. I just have to change it on my end. Now this one tells you that this pair is in congestion and it's between both power dots and trend stop. Let's go to the US CAD. You can flip from one chart to another, no problem. And I'm doing this on the 30-minute. So this is because it's on the 30-minute, it tells me that any time that they plot on the 30-minute, I know about it. Now you can program this to email you so that you get an email on your phone and that wakes you up to know the time that you need to look at the trade, or text you. I don't know how to show you that. That's something you're going to have to call NinjaTrader and have one of their techs do it for you. But so now we're looking at the US CAD. Let's see what happened here. Great trade yesterday afternoon. Why? Again, they identified a level, and this price point was 116.33. Now granted, here they identified the same level, and every time it came down, and it came down to 116.04. So we're talking about 30 pips. Not a big move, but significant for us to realize that they're playing this range. Power dots show up means a very powerful price level that they're going to be respecting. So here what happened? Let's move this more towards the center. They did the same thing. Now, knowing at the open, granted it went long because they gapped and they went long, but I would not have taken this long trade. I would take this trade short. Why? Because this is telling me to take it short. Now on the 15-minute, you had plenty of time. Plenty of time. Let's look quickly on the 30-minute, which is where we're getting our signal from, to see what it looks like. Hopefully we'll have a very good Friday. We should have non-farm payrolls come out on Friday, actually. Let's take a look at that. Are we going to have non-farm payrolls on Friday? No, we are not. Are we? No. Wow, they're going to wait a week. That's a crying shame. I was hoping Friday to be a very good day for us. Okay, so this is 30-minute. Now here it's plotting again, aggressively. So what does this tell you on the higher time frame? That more than likely they're going to drive it down. So they're not ready to break out of this range, but they're not going to drive it all the way down here. More than likely it'll be halfway at 116.17. But they plotted, and look how they've been plotting against this level. They never break above it, except this one time, and they pulled right back down. Good example. Let's go back to the 15-minute. Now, is it fair to say that they're making their decisions off of the higher time frames than the smaller time frames? Yes. Is it fair to say that they don't necessarily make their decisions off of the 1 hour or the 4 hour? The answer is yes, they don't. However, they do use those price levels to map out their plan of action. That's it. Nothing more, nothing less. Don't get confused. Again, the 15-minute, it plotted here, and on the 30-minute, it's plotting here. So if I'm seeing that on 30 minutes plotting here, and I'm seeing that every time they come up, they pull away, and in this case, they are really pulling away, and this is another level now that we identified, which means that they would go bearish from this one, then what is that telling you? That this is not a valid trade to the upside. That more than likely, they're going to take their time, and they're going to drag this thing down. That's pretty much it. They're not doing it now. Doesn't mean that they won't. It means that they're not doing it now. So you wait. Now, let's take a look at the volume here. I think this would be a good example to look at volume. Here in this specific candle, they offered 82 million and bid 84 million. A difference of 2.7 million, again, because of the fractional bids and offers that they put. Let me get the pointer so it doesn't interfere. So in this candle, that's quite a bit of volume. They drove it up, but look at their open, high, low, and close. Not much of a difference. Their open, high, low, and close on this specific one was 116.27, 116.40, the low was 116.27, and the close was 116.31. So they took it all the way to 116.40, but they closed it at 116.31. Interesting, isn't it? But their volume is what we're interested in. Why? Because as aggressive as their volume was, it didn't drive it all the way up and didn't close up here. It closed below this level because they know that if they trade above this level and they close above this level, they're going to have to run. And they're not going to trigger everyone else's algorithm because they're not that foolish. Now, let's look at this one. They offered 43 million to sell. They dropped significantly what they were selling. They had 109 million on the bid side, a difference of 67 million that they could not provide for. Big difference. And then this next one pulled away. 70 million on the sell side, 45 million on the buy side. So now they had less buyers. They were selling, but more to actually bring it down. This next candle, 43 million on the sell side, 37 million. So as you can see, they started to drop aggressively. Here, 29 million on the sell side, 45 million on the buy side. You know, a bearish candle with bullish volume. Go figure. Came right back up again to retest. 46 million on the sell, 32 million on the buy. This next one, 55 million on the sell, 29 million on the buy, and nothing. So what does this tell you? That this is going to go short. Because that's what they're doing. They're rebalancing their buy orders to get out of their buy orders to sell, to come down. That's it. There's no other story except that. But you would have never known that if you would have never identified this price level. which is the one that they've been using, 116.33. So this gives you an idea pretty much of what you can expect. And so now you know. So we've easily mapped out what their intent is, which is to rebalance their risk to the upside by bringing it down. But everyone here, a lot of retail traders were caught saying, oh no, this is going to go long. Look at this. This. Look how they spiked this thing. Are you kidding? They're getting ready to go long. They're not. The answer is that they are manipulating this information with price action when the volume is extremely high at these levels because they want to get out of their buy orders to sell. That's it. Nothing more, nothing less. So if you can come to terms with that reality, then you can come to terms with learning how to trade with an institutional mindset, because that's exactly what we're showing you. We're showing you the mindset, the protocol, the plan, the formula that the banks and the market makers are using to trade this market. And if you can conceptually accept that and discover that this is the truth, not a lie, because it's mathematically calculated. How can you contest something that's mathematically calculated? Can you continue to trade without it? So, being that said and done, don't you think that you need this type of information to trade? Now, granted, you're not going to learn it in one day, nor am I pretending to lead you in that. It's going to take me 3 days to train you on how to use this. Now, normally, when I do a training, I don't do it one day after the next. I usually spread it out 2 to 3 days each day, so that, because I give you homework. I give you time to reprogram yourself, to learn how to incorporate different things. Again, look, we added the moving averages, so why? Because I wanted you to see that the moving averages are useless. In no way are they telling you take the trade. And with this amount of volume, that they drive here, don't you think that the moving average would actually move? Would show you that they're really interested in taking this down? No, they don't. So if you're trading moving average crosses, this was a great moving average cross, but it was late. We saw the trade here. There was no cross. This was going down. The moving average was taking everything down, but we knew that they were going to drive it up. Here, they're telling you to go long. Our indicator's telling you to go short. Look, they're going short, because they're not planning on going long any further, so they're going to bring, but moving averages are telling you, hey, go long. And I'm telling you that our indicator is telling you to go short. So I think that makes a difference. Let's look at another pair. Let's see which one makes, the pound yen. I like the pound yen. Pound yen is a very interesting pair because it's a very volatile pair. A lot of people fear it. A lot of people like it. I don't fear it because I understand it. I look forward to it. When I get a signal on it, believe me, it's like if you're giving candy to a baby. And babies love candy. Why? Because it's sweet. Because nothing tastes better than it. Except milk, of course. But candy is the substitute. So give it a second for it to populate. Now, I am going to be opening up the trade forecasting in January. So Just want to make you guys aware. Now, this is a great signal. And we had 3 great signals. We had one at the open, as you can see on the 15-minute. Look at that, beautiful. Right below this level that told you it was bullish. And this move, actually caught this move yesterday with my student. This was a 53 pip move. Now, if my indicator is telling you that they're going to drive this thing long, are you going to take that trade or are you going to let it go? Is the next question. When mathematically it's telling you they are going to take this long. At the open, a lot of traders out there say, you know, you shouldn't trade the open because you never know what's going to happen. I know what's going to happen. If my indicator is mathematically calculating and telling me that they're going to drive volume and momentum and drive this thing up, you know what? I'm going to go long. Because these would be the easiest 53 pips that I would make. Now granted, I didn't get a sell signal here and I didn't care because I already got the buy signal here. If it started to reverse, I get out. Okay, so I get out with 40 pips. Big deal. I made 40 pips. They came back down below this level, came right back up. I still didn't have a buy or sell signal, but then they came up here and they gave me a signal here. And guess what? They came right back down to the open. So I had 2 trades, one at the open, another one right here, which was at about 1:30 a.m. my time, which is 4:30 a.m. Eastern time, and this would have been a total of 39 pips. And now they came up, and now this level, these power dots formed lower than this one. What does this tell you? That they're going to go short even more. So before this thing went short, you actually had 30-minute window when it plotted. 30 minutes before getting in. That's pretty significant. So if you're getting a 30-minute to an hour window to actually determine your entry, isn't that a lifetime of information before you take a trade? I mean, a lifetime of information? When before we were happy if we got a minute, or 2, or 30-second signal. You're getting a 30-minute window minimum to take the trade. A 30-minute window, ladies and gentlemen. It doesn't get any more simplified than that. So where is this expected to go? To this level. What's this price level? 187.11. That's it. Nothing more, nothing less. So if you know where your entry is and you know where your outcome is there any fear? No. Let's say you would have gotten in here on this one. The total move here would be 31 pips. If it gets to that. You're not going to make all 31 pips, but let's say that you make 25 pips out of that move. Those would be the easiest 25 pips you ever made. So this pair alone gave you 3 trades in one day. Gave you 53 pips, gave you 39 pips, and then it confirmed another 31 pip move. So that adds up to a total of, let's count. Let's bring out the calculator. 53 plus 39 plus 31 equals 123, and say minus 10 pips because of the spread. That means that you would have picked up 113 pips on this one currency pair in one day. That's not bad. So am I saying that by using this information, you can make up to 100 pips a day? Yes, you can. Personally, I like making 40 to 50 pips, minimum 30 pips. I like these trades during the Asian session. Why? Because I don't have to lose sleep during the European session. Many of you are trading from Europe. So of course you would be losing sleep if you woke up at the open of the new day, which is 5 p.m. Eastern. So it makes it much easier for you to take a trade at 4:45 a.m. Eastern because it's during the European session, and you would have picked up these 39 pips and you would have been done. You could have put a market order and put a sell order knowing where, or put a trailing stop knowing where it's going to get out, because you knew that they were going to come right back to this level. So if you put a trailing stop, you're solid. What more do you want? Question. Will you analyze the power dots at 20 minutes and tell why it wasn't a valid buy signal? Sure, let me go to the 20 minute. Data series. Or wait a minute, at 2000 hours. Here. Oh, good question. Why it wasn't a buy signal? Well, here for instance, you saw how they were coming down in a steep angle. Whenever you see the trend dots and the trend stop coming at a steep angle, it means they're going to break right through it. So, why wasn't this a buy signal? Number one, because it wasn't at this level, which was a strong support level. Price action was coming here. Price action here had not flattened out and not settled. So if we would have seen price action here settle and done more of this, then it would have been a valid buy signal to the upside. The fact that it came down aggressively, broke through it, you know, even though it plotted here and it plotted from a small distance from here. However, the aggressiveness of the price action toward it was too aggressive, and they didn't give time to settle and rebalance their orders here. If we would have seen them rebalancing their orders the way they do here, and you see how the trend stop flattens out, then you have a valid buy signal. When it comes in like this, there is no valid buy signal. Why? Because it is aggressively moving against this direction, because they need to rebalance, bring it right back into balance where they opened from. So they came in, they went right back up, came back down, went right back up. Now, let's say you would have gone long from this, from any of these positions. What would have been your risk? Because it did go long, but didn't go long aggressively. Let's say you would have gotten in here long. The maximum that it would have gone against you would have been 10 pips. And then it went up practically from this level to this level, maybe 15 pips. 22 pips max. So you would have picked up about 15 pips. But if after seeing this move, this was really not a continuation move, because what happened here, and this is something that you have to basically just watch and see, if they would have broken through this trend stop, then they would have ended up coming back here, settling, and then driving it back up. But they never broke through this trend stop. So sometimes, if the distance is too far from the trend stop and the trend dots, it means that they're going to come down aggressively. So any trade to the upside would have been questionable. I like to see trades when they settle, when they go flat, to basically rebalance and then drive up or drive down. In this case, because they had already come down and then plotted here, and this plotted right above this, and you had a pivot, this basically told me that they were going to bring it back down. This was not a valid trade for me, but this was a completely validated trade. Why? Because when it plots here after a move like this, it tells me that this is a counter trend trade that they did, and they have to come right back down. So it's more solidified for me. It's more validated. Again, this one here, same thing. They came down, came right back up, never really coming all the way up to this level. and these power dots plotted below this level. So that means that this trade was coming down, and it did come down. Now the question is, will they break this level? If they don't, and this is something that we have to wait and see, then at that point I would be more interested in taking the short. But right now I'm not interested in taking the short. Why? Because on the higher time frame, if we go to the higher time frame, like the 180, we might see what we saw in the US yen, that they may be setting up to go long. Was the pivot the confirming signal? Yes. The pivot was a confirming signal that they were going to go back down. Let's go to the higher time frame and then work our way back. This is a good pair to look at, actually. Let's give it a second. Usually takes a minute, not more than a second. Okay. So here, for instance, you can see that they've been plotting on the 180, not for more than a week, for 2 weeks, that this is going to go long. The same thing we saw here. You know, it plotted here for 2 weeks and then it really came down short. So the fact that this started to go up tells me that they're really going to make an explosive move to the upside eventually. The only thing is that we have to determine where exactly is their support level. Is it really here or is it here? I'm thinking that they may come back right here and retest this trend stop. So that means that it could come back to 187.11 and trade off of that level. If that is the case, then I'm looking for entry points from this level to the upside. Now, if that's the case, then I'm going to wait for them to come back and retest this level and then get in. So this being where we're looking right now, and we've already identified this level because they bounced right off this level to the upside, we know where our entry is. So if they come right back down and retest and come close, I'm interested as a buyer. Why? Because they're telling me that they're going to buy aggressively. Because for the past 2 weeks, they have been plotting and deciding this. That's why. So the 180 is very significant for me. Let's go down to the 60-minute. And see what the 60-minute has to say. A very interesting lesson today to look at. Let's give it a minute, because if I say second, it'll take longer. Now, the thing about the market analyzer is that you can change the time frames in the market analyzer to give you a signal. And I'll show you how that's done. So here, we said 187.11. So if it comes back, it may not come back all the way, but they may bounce off of 187.18. And if they do that, then I'm interested in buying. I don't care that this is said go short on the 60-minute, because granted they did go short, but realistically the 180 is telling me that they've been planning this for weeks to go long. And they're going to go long, and they're going to break right through this price point when they do decide to do that. So the yen, the US yen is telling me that they're going to drive it long. The pound yen is telling me that they're going to drive it long on the 180. So I'm going to wait for them to drive it long, because it's going to be a very, very midterm position, you know, that should last a few weeks. So we have to give it time to evolve, but we know that our entry will be around this price between 187.11 and maybe 187.02 if they were to come back and retest this level. So now we understand that. But look here, we have a pivot right here on the 60-minute, and that's why they drove this up, right at 187.11. Now let's go back to the 30-minute. Let's give it a minute. Now with the trade forecasting, I'm going to explain how that works once we finish analyzing this pair. And I think you're going to like that, the concept of how we're going to implement that. We actually choose one day out of the week where we do live trading real time. We do not go over indicators. We actually look for trades. Now this is the 30-minute. Now the 30-minute coincides with the 180-minute, which is plotting right here. So we know that this is coming down, which is not a problem. We knew that it was going to come down anyway because the 15-minute told us. And as you can see, even the trend stop here is flatlining and telling you it's coming down. That's great. When I see on a higher time frame that the trend stop is flatlining, that tells me that this could be a valid move to the upside once they settle. So I'm going to start to look at volume very aggressively when they get to this level. So the 30-minute is plotted right above this level, and if it plotted right above this level, that's why this trade was valid to the upside on the 30-minute. We were looking at the 15-minute. Now the 15-minute normally will give you intraday trades, but you never want to go against the trend of the 30 and the 180. So if you see power dots forming in those higher time frames, just be respectful, because they'll bring price action right back down to them, but they won't break those levels. So if you know they're not going to break them, then you can take those trades right back up. And that makes a little bit more sense. So let's give this a minute for it to bring the chart up on the 15-minute. We're almost there. Almost there. Come on. There you go. So, did we not say that it was going to go short? Did it not plot and tell you that it was going to bring it down? It did. Came up, rechallenged, never broke above this level. Why? Because they know that if they break above 187.41, they have to come up. And they're not going to go up when they're planning to come down. So, these power dots are basically telling you and guiding you. Now, this pivot right here, though, in the way Jay mentioned, also was a confirming data point telling you that they were going to bring this down. So these pivots, whenever they come up, around these levels that are identified by our algorithm, they're golden. You do not want to trade against the power dots ever, because you will feel the pain of loss. And that's what we try and help you avoid, is the pain of loss. Because at the end of the day, we're helping you understand the trade by guiding you with the protocol and plan of action that the market makers are unraveling for the day, removing fear. Why? Because we've mathematically calculated the outcome and uncertainty. So now the only thing that you need to really learn how to do is determine how many lots you want to put into the trade and where your exit is. what your greed factor is, and I can't help you control that. That's the one thing that you have to overcome yourself. All I can do is guide you on how to use the software correctly, and from there on, it's on you. Now, being that said and done, I think that we've been able to explain every component of this, except for this one. This I use as I call the Phoenix sentiment, and it really works as a heat map, but it's a little late in the game. Like for instance, right here, you see how we had these dots here? It was bearish, then became a little bullish, and then finally when it went, completely neon turquoise, then it moved. Sometimes it'll be late. Then this one here, as you can see, it came down aggressively, but it was too late. And then it went bearish here, but there was no bearish move here. It was more of a bullish move here. So sometimes it lines up, sometimes it doesn't. I use it as a visual for myself. Now this indicator, the Phoenix radar, this one helps to tell you how they are trading the British pound, which is the orange line, against the yen. If they're taking it out of balance and bringing it back into balance. And I have a completely different indicator for this, which shows all 8 of them, which is a fascinating thing when you see how they are balancing and rebalancing the currencies against one another. A really fascinating thing, because it validates my theory, which I call currency portfolio rebalancing. But I can justify currency portfolio rebalancing based on the volume, on how they rebalance in certain levels as well, where they normally induce traders to go short when in actuality they're going long. In this case, everyone said, oh, this is going to go long, because it came here, didn't go all the way down, but then our indicator came up and said, nope, hold your horses. And the distance between this was very significant. That's another thing, that whenever you see a distance from the power dots to the candles of about 10 to 15 pips, then the move is validated. This case was 7 pips, and this next one, that's why this one gave you 3 great trades. I mean, this was awesome. 12 pips. So here you had 11 pips, here you had 7 pips, here you had 12 pips. Completely validated. Completely validated trades because of that as well. So let's go over the trade forecasting and how that works. Basically, for those of you that have bought the software, your first month includes one live trading session, which is a Thursday from 1:30 a.m. to 4 a.m. and I'm going to extend that to actually to 5 a.m. And this will be twice a month. Then we're also going to do Thursdays, and this is Eastern time. Thursdays from not 7 p.m. but from 5 p.m. I'm going to change this to from 5 to about 8 p.m. Eastern time, or 9 p.m. and this will be during the Asian session. And the reason I'm doing this is because it'll help you guys to see how I use these indicators live and find these trades. So you're actually going to see me trade live, which is something that very few of you have seen before, and those of you that have seen me trade live before know that when I trade live, I don't miss. I look for high probability trades in my favor because I look to basically unravel their plan of action, their protocol for the day. And if our indicators are lining up with their protocol for the day, then guess what? We're probably going to make 40 to 50 pips in the first trade. During the Asian session, during the European session, we may make between 30 and 100 pips, depending on how volatile the market is. So that means that 4 days out of the week, you can look forward to averaging between 50 to 100 pips with me. That's not bad. Now, for those of you that have bought the software, I'm going to also give you 7 more trades during that month that I think will be very good trades for you to make pips on, whether you're demo trading or trading live. Whatever you do, it's up to you. But you're going to get seven more trades from me. And you're going to have a 30 to 45 minute window before they happen. Now this isn't free. This costs $197 per month. For those of you that don't have the software, that's what you're going to pay. Because 4 days out of the week or 4 days out of the month, we're going to make pips. Small price to pay when you really think about it. So being that said and done, that's how the trade forecasting works. Now, the holidays are not over. You can go to the blog and you can see the trading videos that we have so far. And we try and post them, every week so you can go back and take a look at them. We have quite a few that we've placed. So understanding the magic strategy of currency portfolio rebalancing, I explain it here very well, which is what I explained to you today. So I think this will help you. Now, if you're interested in the technology, in the indicators, when you click on each indicator, it will tell you, basically, describe how the indicator works. Of course, it will never describe how I help you to use it, but it does the trick. You can read the story behind it, the power dots, the sentiment, the volume indicator. Now, the end of the year isn't here yet, so I'm still running the special. Normally, for a 3-day training plus the indicators, I charge $39.97. For those of you that are interested, today, for this week, for the remaining part of 2014, and that means you only have 2 days, I will drop this price to $35.97. You get a 3-day training webinar with me. You get the indicators. You get the market analyzer. And you get the first month free with the trade forecasting, along with 7 trades that you're going to get, plus the trades that we take during the live trading room. That's a pretty significant value for what you're getting. You're getting a lot for what you're paying. Granted, this is not inexpensive. This is a high-ticket item. However, can you afford to continue to trade without it is the question. And that's a question that you have to answer for yourself. But if you do have questions and if you are interested, then you can get a hold of me. And I'm going to put my email here for you so that you get a hold of me. It is ricardo@phoenixtradingstrategies.com. I am also going to put my phone number for you. So if you have questions and if you want to talk to me, feel free and give me a call. I just dropped it in the chat. And if you're interested, I will send you an invoice so that you can take care of it through PayPal. I want to thank you very much for joining us today, this December 29th, 2014. And if I don't hear from you, I will see you Friday morning this week for us to go over and find some nice trades, because that's what this is all about, is unraveling the market maker's mystery. So, have a great week. Happy New Year. Look forward to seeing you soon. And thank you for joining us at Phoenix Trading Strategies. Take care now.